is that I actually do the providers. So we're going to cover what I call 7 tax myths, right? So these are the most important things you need to know as you go into tax season. I promise you at the end of it, we're going to have a bunch of free resources for you. So, just, know that that is coming. One thing I want you to get out of this, if nothing else, as we talked this morning, it's money. When I talk about taxes, we can talk about it in terms of compliance, audit prevention, a whole bunch of things that are going to make your eyes glaze over. But what I want you to hear today is that this is about money. This is about putting money in your pocket. I'm going to talk a bit about what kind of money we're talking about. But when we work with childcare businesses, and I should mention, for example, we're doing right now the largest family care network in the country. We also do the business coaching for Texas, so all 15,000 of their providers. We're in year 3 of the sole source of doing the business coaching in Georgia with all of their child care providers, both centers and family care. I say all this to say that one of our framings, when we work with a child care business and we're trying to help them make money and save money, taxes are part of it. We view it as another revenue stream. So when you think about taxes, I know there's a lot going through your head, but think about money. And, I know that very often when it comes to taxes, there's fear, there's misinformation, right? There's things that you hear that are wrong. I spend probably more time than I should admit on the, and this is what they call themselves, so please no one be offended, but the daycare business owners site on Facebook, which has a huge following. So many times a week, I see misinformation on there. And I also see a lack of information. And so many times you are not making the money you should just because the information is here and you are here. And we're not bringing those together. So part of what we want to do is we want to make that connection so that you can make more money through taxes. So number 1 myth we're going to dispel today. Taxes are something to be afraid of. This is going to be interactive. So, at points, I will make you use the little emojis that you have. How many of you feel anxious or overwhelmed? When I say the word taxes, I mean, when you saw it on the agenda, some of you must have had a gut reaction, right? Any emotion? Okay, Megan, thank you. Most people, do get a little bit anxious when we talk about taxes, and that's absolutely understandable, right? It's a little scary. You're in a situation where you feel like you don't know all the rules, just like we were talking about. There's information here that you don't have, and you're here, right? It's something where you feel like you have to rely on others. It's out of your control. But the consequences aren't, right? And so you want to be very careful, but at the same time, you feel like you may not know as much as you want to. Let's change the way we say this question. How many of you would want an extra $7,600 a year? Anybody? I like money. Nobody else? Okay. Okay, so we're getting a few people who like money. I appreciate that. That's good to see. So I personally do like money. And this $7,600 number is on average what we found can be saved through tax education. So again, when we bridge that gap between the tax knowledge you don't have and you over here, and we can bring them together, $7,600. Now that's not deductions, that's money in your pocket. That's tax savings. And this comes from a data set of provider tax returns, real provider tax returns, by the way, some of them from New Jersey, that includes both family care and small centers, defined as 25 or fewer employees. So this is not, we worked with 100 Goddard schools and we're able to save them some money. This is providers just like you saving this amount of money. And I feel like one of those late night commercials, right? Like, and you can save even more. I mean, there's one provider, family care provider I worked with in Wisconsin who we saved over $13,000 for. And this number, as we do more of this tax work around the country, this number is holding, by the way. What we find is it repeats again and again in our work. So it's pretty good. It's pretty reliable. The other thing to think about is that this is not a one-time amount of money. This savings is typically repeatable year after year. So if you get these habits, you're suddenly creating an income stream. That's not bad, right? It's a pretty good amount of money. So let's talk about the next tax myth, right? Myth, and we're going to start talking about some of the ways that you actually realize that $7,600. And that's through depreciation. And many people, if you know anything about depreciation or you've heard of it, this is probably the one that's going to give people the greatest anxiety, right? All it means, if people start getting, childcare business owners, get very anxious when we say depreciation. All depreciation is, it is taking a cost of an asset, something you've purchased for your business, and spreading it over what's called its useful life. Now, the fun is that its useful life may differ, right? And we can certainly talk about that. The free guides that I'm going to be sharing with you have more information about that. But what it means is that if the IRS has defined a given item has a useful life of, let's say, 3 years, if with a large expense item, you have to divide it over 3 years. So that's an easy concept, right? The challenge comes when your taxable income doesn't match how much that you're actually spending in a given year. So let's say, for the sake of argument, that, in 2024, you spent $30,000 on an item. The IRS says it has a 3-year useful life. So that means $10,000 a year for 3 years that you get to deduct. The problem is if you spent the $30,000 already, right? The $30,000 has left your account. So you don't have that money anymore. On that first year taxes, you're going to be treated as if you only spent $10,000. Now, as you can see, 25 and 26, you're going to end up with a deduction that you didn't have previously, right? There's no expense around that deduction. So you will, quote unquote, make it up over time. But the problem is that first year can be so difficult, right? Because the money has already left your account. That's why many people get very uncomfortable, nervous, anxious, upset, any of those things when you talk about depreciation. And by the way, this is where, especially over the past few years when there's been some really great programs to provide additional money to childcare businesses, that this has been one of the challenges they've had at tax time. So many people, and this happens every year, even after those grant programs ended, so many people reach out to us every year and say, I have a much bigger bill than I ever thought I was going to have this year. And so many times it is just because of depreciation. They weren't expecting depreciation. However, if you use depreciation to your advantage, it can pay off. And in fact, the case that I mentioned, the family care provider, a lot of that $13,000 was because she had done a number of different things with her home and had found that she had not depreciated them, or rather her tax preparer had not depreciated them correctly. That's where it came from. So she was paying more in taxes this year than she needed to. So what you want to do is, as you think about depreciation, you want to think of ways that you can accelerate these items wherever possible. And so, how do you accelerate them? One, typically, and by the way, in the guides I'm going to send you, there's a step-by-step on understanding depreciation because it's worth it. It really is. But first of all, expensing wherever you can. Typically, if the item you're buying is $2,000 or less, you can expense it. That means you can just treat it like a current year expense. That's one down, right? Two, if you're buying a piece of equipment, if you will, right, and that's pretty broadly defined, you could use Section 179 depreciation, which is another way to accelerate it. Further, with the passage of HR 1, One Big Beautiful Bill, this past summer, bonus depreciation is back, which means there's another opportunity for 100% acceleration of your depreciation. Finally, and this is an important one for if you're a home-based provider, there's also what they call a safe harbor, a real estate safe harbor for renovations. And this comes out of the real estate industry. It does work if you're doing renovations to your home as well for your business. It also actually could work for Center too, by the way, if you own the property. But essentially, if you have certain renovations that you're doing that are distinct, right? So it can't be $10,000 out of the $100,000 renovation, right? But let's say you're redoing a more distinct item, like let's say refacing the cabinets in your kitchen, and the business use part of it is $9,000. Well, if it's $10,000 or less, you can use this safe harbor. And again, that helps to accelerate that depreciation. And again, the guide takes you step by step through it. I'm trying not to kill you all on a Monday morning at 10 a.m. with a deep conversation on taxes. But what I want you to get out of this is take a look at the sections on depreciation, understand them, talk to your tax preparer about them. If you're going to do your taxes yourself, and we're going to talk about that because that's another opportunity, pay attention to the depreciation section. The other thing I want to talk about with depreciation, because this is such a common myth and it drives me crazy. We'll hear many times that family care providers will say, I could have depreciation against my house, but I'm not going to do that because I've heard on the internet, a highly reliable source, the internet, that if I take the depreciation, then when I sell my home, I'm going to have to pay the depreciation, pay tax on it. Here's the sad reality. And in fact, I just had this come up 2 weeks ago with a family care provider who's selling their home. Depreciation recapture, which is is a fancy way of saying the taxes that you have to pay on any depreciation that you took for the business use of your home, is going to happen no matter what. If you never take depreciation for your business, you still have to pay depreciation recapture. So you really have two options. You can pay the taxes and never take the deduction, or you can take the deduction every year and at least be earning that money along the way ahead of that situation that you'll be in where you have the recapture. So again, as you think about the tax year, as you think about, especially your home-based providers, when you're thinking about whether you should or shouldn't take this depreciation, there's a lot of people out there who are telling you false information that this is, and by the way, sometimes it's tax preparers too. So just know this is worth doing. We see it all the time. It's good money. Another one we hear is the business use of your home deduction is not worth the effort. Could not disagree more. When we look at, well, let me ask you this question first before I go. How many of you who are eligible, right, to take the business use of the home deduction, how many of you are taking it? Are a lot of people taking it? I warned you, it's going to be interactive. Okay, got one person going. All right. So either folks are falling into one of three categories, right? Either they're not taking it, not eligible, or still waking up at 9:30 or 10 o'clock on a Monday morning. So what we found over the years is all too many times, family care providers in particular, and sometimes centers who are eligible are not taking the deduction. If you are a family care provider, this is bar none the best deduction that you could be taking. Now, why are they not taking it? One, they hear that there's an increased chance of an audit and it's complicated. If it were 1983, I would say yes, there is an increased chance of an audit. It is not 1983. What's happened over the years is that over time, the IRS has seen the way the world has gone, and they are more and more comfortable with the business use the home deduction. They know people have home-based businesses. So it does not come up as an audit. And I'm not saying this, with any affect either way, but with the recent cuts to the IRS, chances are that they're not really concerned about your business use of the home with the audit resources they have. So that increased chance of an audit hasn't been true for years, decades. This complicated piece, typically it really isn't. Typically, you have the information already, and it's a matter of categorizing the information. And even if you do feel like it's a bit complicated, again, coming back to what I said earlier, this is one of the best deductions you have. Your home-based provider, and again, if you're an eligible center, that home office, if you're an eligible center, if you're a family care provider, that home is a huge opportunity because you're spending a lot of that money anyway. And so what do I mean by that? If we talk about the major deduction as sunk cost, you're paying your rent, you're paying your mortgage, you're paying your utilities anyway. There are tax laws, and we'll talk about them in a minute, that only benefit family care providers. That's not me engaging in hyperbole. They literally only benefit FCCs. So if you're a family care provider, you're getting a benefit just through the tax law that no other business is getting in the country. And finally, there's a lot of people who say, well, I can't understand time, space, and how we do that calculation. It's really not that bad. It can be done. And, as we talk about some of the resources you have, we even have like a worksheet that you can do it through, and a spreadsheet, right? If you feel more comfortable with electronic means. So there's ways that could be done where it isn't going to swamp you. What we do find, unfortunately, is that many tax preparers won't do it or will discourage you to do it from doing it. We encourage you to. It's a big amount of money. And let's talk about why. And this is, especially if you're an FCC, right? Time include the hours of operation and preparation, right? So how does that add up? So what do I mean by that? If, let's say, Grace, just pulling one name, works, let's say, I'm going to pay you 50 hours a week, as a family care provider, but then let's say every Sunday you do prep, you do snacks, you do a deep clean. That's another, let's say, 6 hours. In that case, weekly, you're putting in 56 hours. Those hours count. So you can see where the hours can start to add up, because it reflects the actual time that you're doing the work fully, not just the time that you're open or that the kids are there. Space. Now, when we talk about the space part of it, this is the part of your home that's being used. Anyone in the country can deduct a home office, which is what they call exclusive space. So you can't see it. I'm in a home office. I have walls. I have a door, right? This is a separate space. Do my kids sometimes wander in here to steal my scissors or other things from my desk? Absolutely. They also come and visit me after school and give me a hug, that sort of thing. That's okay, right? But because by and large, they know this is my office. It's an exclusively used business space. Everybody in the country can get that. If you, by the way, are a center and you do not have an office that you are using at your center, you may be able to deduct your home office. Similarly, you could do the same thing with storage. If you have a storage area, so in my home, I have a storage area for all the Civitas stuff, right? That square footage can also be included because it's used exclusively, right? We don't have other stuff in that area. However, if you're a family care provider, you also get to do what they call regular use space. So this gets really interesting because the definition is kind of squishy. All the IRS says is that it's got to be used regularly for your business. So what does that mean? Real use cases we've had. A provider does not allow the kids in her kitchen. However, every week she does food prep in her kitchen. That is regular use. She's using it regularly for the business. We had another provider who had a child who only came in on Fridays, right? And that child was a light sleeper, was not used to sleeping with the other kids in the same area. And so even though her bedroom, actually it was her daughter's bedroom, was normally off limits, she let the child sleep in that bedroom every Friday. That is regular use. We had a provider, similar situation, normally does not use her living room as part of the operation. However, and I never quite understood why, but when she wanted to do a STEM exercise that she did every other week, it was in the living room. That's regular use. So you can see how space starts to get unlocked in your home, right? And it can start to add up between the space and the time that we've talked about. It starts to add up very high and very quickly. What I would say is this. What I have found is, and this is why it's such a good deduction, is that it tends to be disproportionate. In other words, you make more off of this deduction as an FCC than maybe, other circumstances would dictate, which is why it's such a good deduction, because it's going beyond just your operation and taking some of your home expenses and making them deductible. So all of that to say, it's worth taking a look at, it's worth working on. And by the way, one last thing is sometimes you will get tax preparers, even with family care providers who are using so much of their home, who will say, just take the standard deduction. They want to do this because it's easier for them. It doesn't help you. It's not worth it. You're going to do better using time space every time. I promise you. Again, I've looked at so many of these things. I can assure you that. Another thing we hear is I don't qualify for tax credits, which is followed by what's a tax credit. So we're going to talk about that as well. So have any of you ever used a tax credit for your business? I'm not seeing many people, if at all. Okay, that's fine. It's not very common. Let's talk about what a tax credit is, right? Because I always talk about tax credits as being magical, right? They work tax magic. Why do I say that? Because a deduction just reduces the income you're taxed on. A deduction is good. Never turn down a deduction. Never. A credit cuts your actual tax bill dollar for dollar, right? So if you think about this is the wrong slide. Okay, my apologies. So if you go to this slide, which is the right one, and you do $1,000 deduction, and you're at the 22% tax bracket, that's going to save you $220. Don't turn down free money. If you have a deduction, take the deduction, right? And I should say, by the way, because many times I'll get a question from providers who will say, but what if I'm taking too many deductions? Is that a problem? It's not a problem. As long as you really did, like, don't take a deduction you're not entitled to, right? Like, let's be clear, there's no fudging. But if you can defend it and it's related to your business and it's allowable, take the deduction. It's good. But $1,000 tax credit saves you $1,000. It's $1,000 off your tax bill. So in other words, 220 versus 1,000, you take the tax credit every time. And so we don't often think about tax credits because very often, okay, so I'll get on my soapbox for a second. And my apologies right off the bat to any of you who has a loved one in your life who's a tax preparer. I'm sure this doesn't apply to them, but it applies to most of the industry. Most tax preparers, it's a volume business. It's like a big puppy mill. They're trying to just chug you out as fast as possible. And in addition to being on the daycare business owner site, I spent a lot of time on tax preparer Facebook groups. I know you're like, I'm a party animal, but this is true. So what you find on those groups is they are constantly talking about how fast to move people through. That's all it's about. That's how they make their money. It's volume. It's like McDonald's. So when it comes to tax credits, it means they have to slow down for a minute. They have to verify that you're legally entitled to it. They have to ask you some extra questions. They have to fill out some extra forms. And frankly, because many of them work so quickly, they may not be as familiar with it, so they might even have to look up the guidance themselves and relearn it or learn it for the first time. So they will discourage you from taking the tax credit. The tax credits are good. If you take, for example, the work opportunity credit, this is a tax credit for hiring selected employees that, rightly or wrongly, the federal government has determined are harder to employ than others. You can get up to $1,200 to $9,600 per employee hired. Think about that. And this includes SNAP, TANF recipients, veterans, and ex-offenders. I would say, by the way, I like to get my hands dirty when it comes to things, especially around taxes, and I don't like to talk about something I haven't done. This is actually something because of our veteran hiring that we've taken advantage of at Civitas Strategies. So I can attest to you, this is not hard to do. And by the way, we have free resources on our sites that will take you through how to do this. It's one very simple form online where basically you're saying how they qualify, and a form that you ask the person you're hiring to see if they qualify. And it comes up a lot. I was talking with one person in New Jersey who was talking about hiring a few new employees, and I asked how many were long-term SNAP or TANF recipients. It was 100%. So think about that for a second. If you're hiring folks and you're doing the right thing, this is a reward for doing it. And likely you're not taking it. Secure 2.0. Biggest issue, according to NAEYC right now in the field, and others as well, is retirement. And we could talk about retirement ad nauseam. And I won't kill you on a Monday morning, but there's a Secure 2.0 retirement plan credit. I don't know why, but it drives me crazy that almost no one in the industry is using this tax credit. If you have 50 or fewer employees, you can essentially give up to $1,000 per employee per year for 3 years. That and the costs of running it are covered by the federal government. Costs you nothing. There is no reason why you are an operation that has employees and you're smaller than 50 employees that you shouldn't be doing this. Even if you say, but Gary, I can't sustain it after that, fine, don't sustain it after that, but at least give your employees 3 years worth of retirement. Again, covers it all. It even covers, like, if you have meetings with your folks to talk to them about the plan, it covers it. Section 45F is a big one the field is talking about now. Again, this is like one, a lot of these tax credits deserve a lot of time on their own. In fact, in Georgia, we now do a whole multi-session group training on tax credits for childcare business owners so they can better understand them. But you're going to hear a lot about 45F. This is a tax credit that has really been powered up, that is for employers. If you're a childcare business and you have employees, 30% of them, and you have to be a for-profit, but 30% of them have to be employees' children. So to keep the numbers easy, on a Monday morning, if you have 100 kids in your care, 30 or more would have to be employees' children before you kick this in. Rightly or wrongly, that's the way it's done. And we could debate whether it should be different. I would argue it should, but that's a whole nother debate. But what I would say is you're going to see, because of the changes in the law, a lot more businesses using this over the next year. So as you hear people bringing it up, as you hear them talking to you about it, this is a real credit, it's a real thing, it's really happening. So again, not necessarily for you, but it's out there. Other credits to be aware of: paid leave credit. If you are giving paid leave to your employees, New Jersey, and this is an aside, has an EITC matched, earned income tax credit match, which is often not taken. Employing your children is too difficult. This is another one. How many of you have employed your children, your minor children, right? So we're talking about 18 and under in this case. Anyone? Okay. Liz, Jane, I see you. Okay, good. What I have found, and this dates back to work that we did in New Jersey in 2020. Oh, somebody is not on mute. It goes back to work that we did in New Jersey in 2021 and 2020. I talked to a lot of family care providers, and what I found was many of them were employing their children, their minor children, and they were doing it off the books, right? And so we found this to be actually pretty common. So if you take the example of Teresa, she's a sole proprietor, she's in the 22% tax bracket. She pays her child $10,000 a year to help after school and weekends. By the way, this is actually based on that first case that I'm referring to, where somebody admitted to me they were paying their kid off the books in New Jersey, right? I'll be more specific, Northern New Jersey, not to pick on Northern New Jersey, but just saying, like, this is a real story. And there were many more after it, right? So now she's paying an additional $3,730 for the privilege of paying her kid off the books, because it now shows as being her profit, her money, right? So it's great that she's paying her kid and she's getting help, but she's losing money unnecessarily. So the opportunity is actually quite amazing. And my wife always cringes when I put it this way, but I'll put it this way, since, you know, it's New Jersey and I love you all. This is like the only way that you could legally launder money end-to-end tax-free in the country. And what happens is, first of all, you deduct the employee cost from your business, right? So you're employing your child, you deduct that expense. You don't have to pay federal payroll taxes because they're their child, because it's your child, right? Like, they assume if there's some sort of disability issue or workers' comp issue that you're going to take care of your kid. Hopefully we all will. I assume we all will. Income taxes to your child. And what about those, right? Well, if you keep it under the standard deduction, which is $16,100 for 2026, they don't pay taxes on it. So far, the money's flowed through the system. Nobody's paid $1 on it. Here's the bonus. Put it in a Roth IRA for them because they're earning money. They are eligible for a Roth IRA, or a 529 for their college education. They don't pay taxes on the money they make off of that. Now you've gotten the money. If we took that $10,000, previously she was paying over $3,000 in taxes for the privilege of paying her child. She does it this way. She's not only saving that money, she could set it up so her kid has to pay no taxes on it at all ever. Not a bad deal. What I would say is keep in mind, because I've seen this misinformation as well on Facebook, right? Sometimes people say you can just automatically deduct it. You can't. It should actually work, right? It has to be a reasonable pay. You can't say I'm going to pay my kid $10,000 an hour to help me clean up. You do have to file a paperwork. You have to file a W-2 at the end of the year, and you do have to do a tax return for your child, which, by the way, is very simple. Like I'm very open about this. I've employed both my kids for many years, and I use H&R Block's free tax app because they don't pay any taxes and they're below the standard deduction. So literally, I do it on my phone with my phone. Answer the question, send it in, it's done. And we do have a guide on how to do the W-2, by the way. It's not hard either. Example, do have evidence. This is my youngest son many years ago, right? But evidence can be logs of their working. It could be as simple as taking some photos when they're working with you, right? So they're carrying that bin of laundry, take a couple of shots, and it does substantiate if there's ever a question. Spoiler alert, I've never heard the IRS asking about it. Just saying. Again, not encouraging you to just take the standard deduction and say, I gave it to my kids. Do it right, but there is an opportunity. Last one, or second to last one, food and transportation deductions are insignificant. I've heard this again and again. Don't do food and transportation because they're too small. How many of you regularly track your food and transportation expenses? Thank you, Catherine. Jane, Sarah, I see you. Awesome. Okay, Betty. Good. Okay. So some of you are doing it, which is great. When I go back to that data set that I mentioned, that first data set where we realized the 7,600 on how much we're saving, right? That included providers from New Jersey, Connecticut, and Wisconsin, right? So you can't say it's just people from out of state. It's literally people from your state. What we found was that 16% of eligible providers did not deduct any food. 45% did not deduct any transportation at all who were eligible. So this is a major missed opportunity, and it can be significant. If you look at that data set, right, the average food deduction is $9,400. Now, again, that's a deduction, right? That's not tax savings, but it adds up. Average transportation is $6,800. Many of you have heard of different types of childcare management systems. There's one that's called Playground, and their CEO, I happen to know well, I'm not endorsing it or anything. CCMSs, we can have a whole nother conversation on the good and the bad. But I say this because I know Daniel well. And Daniel, this was at the NAFCC conference 2 years ago. They had just added tracking mileage for providers. And literally like 2 days before the conference. And the first thing he said to me was, he said, Gary, they're sitting on so much money and they don't know it. He's looking at the data. FCC's centers from around the nation who use the system. And he said it was crazy to see how much mileage they were accruing and they don't even realize it. There's a lot of mileage accruing. Remember, if the majority of a trip is for your business, you can deduct the mileage, right? So if you think about, you go to Costco and you're buying some snacks for the kids, and the majority of that shopping is for the business, you could deduct that. If you have to go down to your local CZR&R for training, you can deduct that mileage. And I know some people have said that they don't do it because they want to keep a log, they don't have to update it. Use your phone. If I mention, by the way, software or anything else, we don't get any money from it. It's all actual things that we've used and we feel like is worth your time and money. Mile IQ is one, Everlance is another, Android, iPhone, it just runs in your background. I've used both, by the way. I like both of them. I switched to Everlance because I was curious and then never went back to Mile IQ, not because it was better, just because. But this will track everything for you. So you don't even need to worry about a log. All you need to do is swipe which way it was. Was it business or personal? So those amounts can add up. And again, there's various ways to do it. You can do full expenses, you could do it based on mileage. Whatever you do, you are going to need a mileage log. So strongly recommend. Your phone's everywhere anyway, chances are, use it. Food expenses, again, also as you can see, they add up quickly. If you are an FCC, even if you are not participating in the food program, which by the way, I think you should, that's the bonus thing. I'll talk about that in a second. But if you are not participating in the CACFP, Child and Adult Care Food Program, you are still allowed to use the Tier 1 rates for your deduction. So it makes it so much easier. And by the way, typically, it makes you more money. And that brings me to the CACFP, just a real quick pitch. Again, this is from looking at more provider tax returns than anyone else in the country. You can argue with me, you can yell at me. People have. But when you look at the money, participating in the CACFP is worth it. And you know what I've seen again and again is that you are getting paid more out of the CACFP than you were spending. And that's not to say like providers give kids grade D meat. You know, what it is saying that the CACFP is built to provide you with an incentive around your costs. It's overpaying you to help compensate you for some of the paperwork that's involved, some of the training that's involved. But I always recommend it, always do. Last myth, I promise. You can't do your own taxes, right? And I know so many people say this to me. They say they can't do it, right? How many of you right now are using a paid preparer? Okay. All right. Okay. How many of you are doing it yourself? Anyone? Okay. I see Nancy. Good. Okay.
No,
So,
not me. That came in later.
oh, sorry. Gotcha. Most people don't. And I think this is a tremendous lost opportunity, right? Um, why do I say that? One, you heard me, what I said earlier. We find providers who miss deductions all the time. And preparers, excuse me. We find preparers who convince you not to take time space. We actually had a preparer once here in Massachusetts who overrode the tax preparation system he used to change the provider's time space number to actually about a third of what she deserved. His excuse, I just didn't like the big number. That's not your problem, right? Like now it's become your problem, right? And they don't like the number, that's too bad. As long as it's defendable, it's a real number. You know, I think what I like is it puts you, when you do your own preparation, it puts you in charge. You're tracking things, you know your business, you know where it belongs, right? You're preparers who miss things all the time and you're paying them to do that. What we have found is, is that it definitely is doable. We've tested every major product out there. We recommend TurboTax. We don't get any money from them or anything else. We recommend them because what we found was when you come to the most complicated taxes, which are typically home-based providers, which are not all that complicated, don't panic, but you have the time space allocation. TurboTax was the easiest to use. And, you know, what we found is that, additionally, is that overall, we're seeing the same thing the IRS does. And what the IRS says is they are less likely to audit you if you use TurboTax or a similar platform than they are if you use a provider. Because they have found that electronic returns have fewer errors and better outcomes for the taxpayer. And we've seen the same thing. And by the way, we've coached providers through this. We also have a free guide that's on our website, and I'm going to give you that in a minute. That takes you step by step through doing your business taxes, screenshots, and everything. All that's free. So, and on top of it, not only do we see these better outcomes with your ability to deduct things, but we're also seeing that typically you're now saving $300 to $1,000 on fees. So, nothing else, right? Don't believe everything you hear. You can do this. You can get this money. You can do it. I've seen it every day. I've seen it in every state of the union, including New Jersey. Every state we work in, 34 states in the District of Columbia. So not every state in the union. I haven't seen Alaska yet. And you can make more money. We see it all the time. And again, this is not one time. It's not a grant program. It's year after year, money flowing into your business. I promised you free resources. Here is the QR code for that. If you go on our website, we do an annual tax preparation guide that takes you step by step through how do you prepare for your taxes. That's, by the way, if you're going to do them yourself or if you're going to bring it to a preparer, it helps organize it, right? There are assessments on there for your taxes, all free. Doing TurboTax yourself is on there, all free. If you have an interest in some of the tax credits we talked about, information up there, all free. And everything is in English and Spanish, and we actually now have the TurboTax guide is in Taiwanese, Taiwanese Chinese. So another option there.